Hi there, my name is Steve McKnight and it's an absolute pleasure to bring you this webinar today. Our title is What Properties Should I Buy, or you buy, where and for how much? As far as this particular webinar is concerned, here is an outline. We're going to start off with a quick intro shortly about property investing. Then I'm going to move on and talk about what properties you should look to buy, where, for how much should you pay. And we're going to spend a little bit of time just talking quickly about inputs and outputs. And then towards the end of this webinar, I'm going to talk to you about how, if you would like to me, I'd like to help you with your investing. And that's very exciting for me because one of the things I love to do is help people to get better results from their property investing, something that's helped me to achieve financial freedom and something that I'm passionate about continuing to help others with today. Right then, part one, which I'm calling a quick intro into property investing. A question I've got for you, and something you may like to think about, is what profits are possible from your property investing? Now, most people will be able to identify the types of profit, which is cash flow and capital appreciation. But a distinction that I like to make is how are those profits actually made? And the first way that I'd like to talk about that property profits are made is via a generic process. Now, generic profits, whether they are capital appreciation or cash flow, are largely driven by the market. So what's an example of a generic capital appreciation profit? Well, buying a property and then over time the market and just forces outside of your control causing property prices to go up. Similarly, an example of a generic positive cash flow outcome would be rent. You buy a property and you hand it over to your property manager and they simply rent it out. Well, aside from generic profits in real estate, there are also what I call manufactured profits when it comes to real estate. And a manufactured profit is something that the investor is able to create by his or her skill. And usually manufactured real estate profits are derived from buying problems and selling solutions. With that in mind, the next question I'd like to ask you is, how is the profit, capital appreciation or positive cash flow, generic or manufactured, actually made? Now, people come up with different things, and let's have a look at them together. The first one is the property. It's the property that I bought that is going to make the profit. Or alternatively, some people say the market. If I buy in a market and the market goes up, then I'm going to make my profit. Other people say, well, it's the user, it's the person, it's the tenant who is in the property, or alternatively, it might be the person who's going to buy the property off me when I sell. And then again, another person might say it's the investor and the skill of the investor, the experience of the investor, their ability and appetite to take on risk that might be important. Now, the truth of the matter is that all of these are factors that can and will influence the profit you can make from your investing. And the point that I would like to make in this brief introduction is the more of these factors, the property, the market, the user, and the investor, that you can have in play and working for you, the better the profit outcome will be from your investing. Often, and unfortunately, many people just have one of these factors at play. They're relying on the property or they're relying on the market. And because they're only relying on one of those four factors, they are missing out on significant amounts of profit from their property investing. Why? Because they're simply not maximizing the opportunity that's before them. I wonder, how many of those 4 points do you have working for you right now? Improving the profitability of your investing might be simply a matter of looking at how many of these other factors you can get in play and working for you as you try and build wealth. Moving on then to part one of our webinar with the introduction behind us. And the question I'm asking is, what properties should be acquired? Now, rather than giving you a specific area like Gladstone or Port Hedland or Ballarat or Launceston, Parramatta, Sydney, Melbourne, wherever, what I want to try and do is be a little bit more broader in our discussion and give you some ideas about what might be the right area for you to be investing in. To do that, I want to start by talking about two approaches towards your wealth creation. The first approach is, in my opinion, the approach that most people use. And that approach is called the asset approach. And reading what's on your screen, under the asset approach, it's the assets that you acquire that determine the outcome you achieve. What does that mean? Well, if you go and focus on buying what you hope are good properties, then it's however those properties perform up until the date where you want to realize the profit in those properties that determines your outcome. If they do well, great, you'll be happy. If they do poorly, well, you may have missed out on an opportunity. The alternative to the asset approach is the outcome approach. And I believe this is the superior approach. Why? Because the outcome you desire determines the assets that you acquire in the outcome approach. What does that mean? Instead of running out and buying assets and getting whatever they give you, what we do is we try and determine what outcome we want first and then acquire assets that are strategically placed to help us achieve that outcome. In the former approach, it's more chance that determines your future. Under this approach, it's more choice that determines your future. Moving on to the next slide and looking at perhaps another diagram, I want to run through this slide with you, is what we want to try and do, or what I'd encourage you to try and do, and what I try and encourage people in the property apprenticeship course that I run to do, is to set the end goal that you're trying to achieve, break that down to a money goal, how much, and a time goal, by when, and then ascertain a property goal about how many properties you need to acquire to feed into that money goal and time goal to feed into your end goal. And then once you've set this property goal, you can think about what properties to acquire, what strategy to adopt, what price points to be buying at, and when you need to realize those profits over what investing period. And we can ask ourselves, how many properties do we need to acquire, what type of properties, and what structure or what strategy? The answer to what is the right property to buy is you want to be acquiring a property that you confidently believe will, first and foremost, deliver the profit outcome you desire. Is it a capital appreciation profit or is it a cash flow profit? Is it a generic profit or a manufactured profit? Ascertain the profit you're trying to achieve, because not all properties will deliver the same profit outcome. Some properties are better positioned to deliver generic growth, some generic income, some manufactured growth, and some manufactured income. The second point is the property must deliver the profit that you require in the time frame that you need. There's no point buying properties that don't deliver the profit you want within the time frame you need to get them, because your investing outcome will be largely irrelevant. It won't be suitable for the purpose for which you're investing. The third point then is via your chosen strategy. There's no point buying a renovation property if you're after a buy and hold necessarily, or there's no point buying vacant land if you're after something that's going to give you an income. And then lastly, with acceptable risk. We all have different risk thresholds and risk appetites. So those 4 points, your ideal property will deliver the profit outcome you desire in the time frame you require via the strategy that you want to adopt and within acceptable risk thresholds. Moving on to part 2 then. Where should I look to buy, Steve? Well, when we think about where to buy, we're obviously talking about location. And so how should we approach the question of where is the right location? Well, here are some thoughts for you, and they're a little bit unconventional, like much of the investing theory, but they're based on what I have learned, having bought 400 properties over the last 10 years or so. And the first point is you need to think about your exit before you think about your entry. Whoa, what does that mean? Well, when you sell a piece of real estate, unless you're in it for the income, you're going to be making the most amount of money. And while you are buying with a certain strategy or profit outcome in mind, the truth of the matter is you will only make that outcome if someone buys the property off you. Now, you can refinance your profit potentially via an equity redraw. But again, the bank will still have to want to value the property, and when they value the property, they'll look at it from the point of view of what would a person pay for it in today's market. So you can't escape the exit value of your investment. So before you buy, before you enter, think about your exit. And in thinking about your exit, more points, think about the time frame. When do you think you might be selling? Think about the target market who will be interested in buying your property. And a little tip for you, a really good practical tip is, if you can increase the appeal of that property that you own as your investment for the target market you've identified and make it more appealing or more convenient for them when you sell, then you will be positioning your property in that market for maximum sales price when it comes time to exit. The third point is the price point. You're buying now, but what do you think it's going to be worth at the time you want to exit? And finally, what sales campaign do you think you'll run to realize the profit that you hope to achieve within the time frame that you expect? So the first point about trying to figure out where to buy is to think about, well, when it comes time for you to sell, what will the market where you're thinking about buying look like? And will it be appealing to the target market that you're trying to attract? Here's an example. And quite often we have inner city apartments. Now, inner city apartments tend to only be appealing for a certain type of person. And that is a person that doesn't have kids, so either empty nesters on the older end or young couples or young singles on the front end. It's very hard to have a CBD inner city apartment that's appealing for families. Why? Because there aren't a lot of schools in city areas. Yes, it's possible it could be niche, but what we want to try and do is say, well, we're going to make our apartment, if we're buying inner city apartments, more appealing for either empty nesters or singles or dual income, no kids. And we have to put ourselves in their position and say, what is it about this property that would make it more appealing? And the more appealing or more convenient we make it, the more value we'll be selling into that property. The second point then when it comes to how to approach location is you need to build a deal profile, because every real estate agent that you talk to will say their property might make money, but you want to be specific about what you're looking for. First and foremost, if you're clear in your mind, then you can go and buy it. If you don't know what you're trying to buy, every property might look like a good investment. And secondly, you can create leverage if you create a deal profile, because you can put it in the hands of a real estate agent and say, this is what I'm looking for, go find it for me and I'll buy it. The alternative is to perhaps spend hours and hours and hours and who knows how much frustration looking at deals and trying to find information only to find that the deal doesn't meet what you're looking for. So in building a deal profile quickly, you want to look at the profit that you're trying to make, the strategy you're trying to execute, your financial resourcing in terms of your borrowing ability and the deposit that you've got available to put down, and the specifics of the actual property you're looking for. What's its land size? What is it made out of? How many bedrooms? What style is it? Etc., etc. The answer then to the right location is any location where your ideal property exists for a price you can afford. No point looking for properties you can't afford to buy, with a target market who wants the solution you're providing. Because remember, you will realize your profit when you sell, and if you're in it for cash flow, you want to make sure that there's a target market renter or creative cash flow, potentially creative purchaser, who wants what you've got and is willing to pay the price that you need to make your profit in order to rent or to use or to buy the property off you. Right then, part 3, we've talked about what, we've talked about where, and now it's time to talk about how much. In order to work out how much you should pay for this property, one of the misconceptions people have is that they want to pay the lowest possible price. And that's great if you can, but it's almost unrealistic because the seller wants to sell for the highest possible price. And so you have a disconnect between the seller wanting more and the buyer wanting less. The truth is, and what I've found, is that if you can offer a fair price, then you're likely to buy more deals. If you're trying to buy the cheapest possible price, then you may find that the number of deals that you have available to you diminishes. And so if you can work out what your fair price is, you can look for properties at that fair price. Otherwise, you've got to play the game, and it's time consuming and a little bit frustration of getting the vendor to accept less than what they're asking for. The first point then in working out how much you should pay is to know the deal. And when it comes to knowing the deal, you need to ascertain what represents value in respect to the properties and locations that you're looking at. In the property apprenticeship, I talk about knowing an area like a local. And how do you know an area like a local? Well, it's time on the ground, it's research, it's good old-fashioned pounding the pavements. You need to know what represents value and what is a good buying opportunity and a bad buying opportunity. That is critical. Why? Because a dollar saved when you purchase is a dollar made when you sell. The second point then is, having known the deal, you need to know the strategy. You need to know how you are going to make a profit. What are you executing here? And in particular, to identify, research and test the assumptions that underpin the profit. Now, if we look at a renovation example here, yes, you can work on your buy price reasonably easy, but knowing how much it's going to cost to renovate and knowing what you can sell the property for are two key assumptions, as well as the time frame that could sink your deal if you get it wrong. So know the deal, know what represents value for an area, and know the strategy that you are executing in order to make the profit. And in particular, under this one, the assumptions for success. The third point then is to identify your worst case scenario. Now, I say this because it was one of the biggest revelations I had when I bought my first investing property. Now, it may seem unrealistic, but back in 1999, I bought it for $44,000, and it seemed like all the money in the world. I know it seems incredibly cheap today, but at the time it seemed very expensive. And why? Because it was relative. I didn't have that much money, so $44,000 was a lot of money to someone who didn't have a lot. But when I looked at this property first instance, I thought the maximum I could lose was $44,000, but that was wrong. The worst case scenario is that if I had to fire sale, maybe I put it back on the market for 30 or 35, perhaps even 40, and there could have been a buyer there. So the reality worst case scenario for me in that first property deal wasn't $44,000, which is what my brain was telling me. It might have been $5,000 or $10,000. And this is the concept of advanced risk identification. And applying this to the slide that you've got in front of you there, when it comes to your worst case scenario, you need to identify your emergency exit and then quantify what's the financial cost of bailing out of the investment. And more often than not, you may be surprised that the risk that you think exists financially may not exist to the same extent. The answer then, you need to pay as much as you need to secure the property. There's no point trying to pay too little if it's not going to buy the property. If you pay too much, then unfortunately, the profit that you might make at the other end is somehow compromised. You need to pay as much as you need to, first of all, to secure the property. Secondly, for a price you can afford. There's no point buying property that's going to send you broke. Where you can make your expected profit, if you pay too much, you may not be able to make your expected profit anymore, in which case you should move on to the next deal. And then based on reasonable assumptions. Often, real estate agents will want you to pay more for potential. Don't pay more for potential, because that's an assumption, what it will be worth at a future time, what you can do for it at a future time. You want to pay a price today that's reflective of the property today. Otherwise, renegotiate. Right then, part 4, inputs and outputs, very quickly. The slide I have here in front of you now is showing the various different inputs that go into a property purchase. And we have the property, we have the amount of money you contribute, the time that you have, and your skill. And these factors all get put into the pipe. We press the buttons, we pull the lever, and out the other end comes money. Now, picking up a point I made earlier in this webinar, quite often people will only put in one point or one matter, the property. They'll throw that into the profit machine, they'll pull the lever, and they hope for maximum profit. Out of these 4 inputs, what do you think is the most important? The property, the finances that you've got, the time, or your skill? Some people will say the property. I'm here to tell you it's your skill. It is skill that drives investment return. It has to be. You could have 2 properties side by side, identical in every way, and it is the investor with more skill who will drive more profit out of that investment. So you need all of these inputs into your machine, but you need a double, a triple portion, more if you can, of skill to drive your investment returns higher. No one can get a bigger output from their investing than the input that's put in the first place. That is a massive mistake people make in day in, day out. If you want to increase your investing output, you have to increase your investing input. And the biggest investing input you can seek to put more in of to get a higher output of is skill. Part 5, how I'd like to help you. Put simply, I have created what I believe to be Australia's best property training course, and I've called it PropertyInvesting.com's Property Apprenticeship. I'd like to work with you to help you to become a better investor. I'd like to be able to offer you the leverage and the skill and the experience that I have, having bought 400 properties. Now, I'm not in a position to personally mentor you. I don't have the leverage to be able to do that, but I am in the position to train you according to a structured program. And I'd like to work with you if you'd like to work with me to improve your investing skill and therefore to improve the input that you can give to your investing with the idea of getting a better output at the other end. This property apprenticeship is a 66-week course. It covers planning, buying, managing, and selling real estate. It gives you the whole investing transaction. Now, some people are more interested in buying. I'm here to tell you the smart money in property investing is made as you manage and as you sell well. Why? Because that's where skill is involved, and all too often people hand that over to someone else to make happen for them. It's a pity because they end up missing out on significant amounts of profit. What is included in the course? Well, first of all, there are written notes. And reaching over here to the desk behind me, here is the course folder for the property apprenticeship, and these are the written notes inside it. The pages are double-sided. There are 66 sessions, hence one session a week, which we're going to cover across 6 modules. And those modules cover, again, planning, buying, managing, and selling. Now, in addition to the weekly notes or the written notes that the idea is that you cover one session per week, I also do a webinar, much like what you're looking at right now, where I pull out certain points in those webinars, flesh them out, and apply my practical experience to those points to make them more relevant and more practical for you. Another important inclusion in the property apprenticeship is peer-to-peer support. One of the hardest things to find is a like-minded person. And you may find that already with your family and friends who look at you slightly weirdly for your interest in property investing. Well, peer-to-peer support is important because we can sharpen and encourage one another. You also gain VIP status within the PropertyInvesting.com family, which means you can come to the market updates I run for free and also the conference that we do once a year for free as well. And lastly, this is Australia's only nationally recognised dedicated property investor training course. And it's mapped to government competencies, and as you successfully complete this course, you will actually be provided with a certificate for in business. How does the course work? Well, each week I want you to read one session, hence 66 weeks. At the end of the session, there are self-study questions to try and help you to apply the theory to your own personal situation. And then each week we do a webinar. The assessment. Now, in order to qualify to be a certificate for in business, there is homework that you need to do and submit. That is our opportunity to test to make sure that you are competent, that you don't just know the information, you can know it and apply it. And that's how we can speak into your situation and provide you with feedback to make sure that you not only know it, which is important, but you're also able to, as I said, apply it in the same way. And at the end of each of the modules, remembering that there are 6 modules, then you need to do the assessment tasks and submit them for us to review and provide feedback on. So what are the 6 modules, you may ask? Well, just quickly referring you to them. The first one, Module 1, Planning and Goal Setting. Module 2 is Investment Strategy. Module 3 is Analysis, Buying and Financing. Module 4 is Managing and Reporting on Property. And Module 5 is Investment, Evaluation and Selling. And Module 6, which is needed for it to be a certificate for in business, is Occupational Health and Safety. Remembering under those 6 modules, there are 66 sessions. I understand that there's a brochure on its way to you, and that brochure will outline each of the individual sessions. The time commitment. Steve, how long is it going to take me to do this? Well, I need 30 minutes from you 4 days a week over 66 weeks. Now, you can give me more time over more days, but on an average, I need 30 minutes a day, 4 days a week over 66 weeks.